Hello and welcome back to Market Shares. I'm your host, Tony Blodgett, and lots going on this week, right? Over the weekend, as I'm sure everyone saw, the United States and Israel launched a campaign against Iran, and obviously I'm not going to talk about that, on Market Shares here, but I do want to talk about what the impact of that can be on both the mortgage and real estate markets. I think it was interesting that the attack happened on a Saturday, which is interesting. I mean, we just don't see that as often. I thought it was interesting. And there was a lot of anticipation over the weekend about how the markets were going to react on Monday. Both the stock market and for those of us in mortgage and real estate, what's this going to mean for the bond market? Now, the stock market kind of reacted the way that you would expect, right? There was like this, kind of flight to safety, and the stock market on Monday, tanked pretty hard. It was down a lot on the second. Now, today's only the third. I'm recording this on Tuesday. You're going to be airing this on Friday. So it's going to be a couple days old, but I think what I'm going to talk about here is going to be super relevant just conceptually about what happens during times like this. But the stock market reacted the way that we expected. What didn't react the way that we might have anticipated was the bond market and mortgage rates in particular. And the reason for that is because although typically when there's unrest in the Middle East, and we've seen this, so many times over, unfortunately, is that you do see this flight to quality, and that typically pushes money into treasuries. That's just a normal reaction when the stock market's down. You see money go into treasuries and the bond market, and as a result, typically mortgage rates would get better. But we have an underlying issue here with this particular conflict, and it has to do with the production of oil. Now, on this podcast, just recently, a couple episodes ago, I shared a graph that shows you how mortgage rates and oil trend so closely together. I think it's something that's missed by so many people. We often talk about inflation. We talk about all these different things and what are rates going to do based on employment reports. And I'm not saying that those things aren't important. And we do see movements, obviously, in mortgage rates based on a jobs report or inflation numbers when they come out. But if you just take a step back and you look at oil prices, as oil prices go, so do mortgage rates. It just works that way. And what we have going on with this particular conflict is the possible disruption of the flow of oil. And as a result, we've seen oil prices jump like 20% just in the last couple of days. And this is the part that we really need to keep an eye on. For those of you that don't understand why the disruption in oil prices, you just have to understand the geography of the area. You see, most of the oil production that comes out of the Middle East has to go through a very small strait. It's a body of water that in many areas can be as narrow as like 2 miles across, which 2 miles seems like a long distance. But when we're talking about the open water in a slow moving tanker in the middle of a war zone, it's not the safest place to be transporting large cargo ships full of oil. So I'm talking about the Strait of Hormuz, and it's literally on the border of Iran. And so the challenge there is that the Iranians have said, look, we're closing the strait and not going to let tankers through. Now, what exactly does that mean? Well, we don't know, but if you're one of those operators of a tanker, you're probably not feeling super comfortable going through that area. And 20% of the world's oil has to travel through the Strait of Hormuz. And so that's what's really causing this disruption. So although oftentimes when you see conflict in the Middle East, the first thought is this creates fear in the market, and fear creates a flight to safety, and stock markets usually take a bit of a hit, and we see that the bond markets are the benefactor of that. but not this time around, because the concern about oil is really a concern about inflation. Now, some people will argue, well, Tony, but I thought food and energy wasn't part of the core inflation numbers. And that's true, right? So may not have as direct impact just based on the price of oil on core inflation, which is what the Fed's ultimately going to be looking at. But as you probably know, when oil prices rise, it raises the cost of everything, right? Because every good that we see on the shelves of every store is transported by something utilizing some type of fuel to get there, right? So just the cost of transportation, the cost of manufacturing, all these things get impacted by the price of oil. And that's why you see such a direct correlation between oil and inflation. And of course, as I've pointed out, oil and interest rates. So one of the biggest questions I've been asked as this week started off here is, what do I think the impact of this war is going to be on interest rates? And my answer to that, unfortunately, is, we got to wait and see. And but what we got to watch is not necessarily how long this conflict lasts in the Middle East, because at least right now, it feels very contained, right? I mean, it's kind of a one-sided war at this point. It looks like, there's been significant damage done to the controlling entities within Iran. And so, their ability to fight back, again, I'm not an expert at, all of those things, and I'm not going to pretend to be, but it looks like it's a pretty contained type of a situation in the Middle East. What we don't know is what is done about the production of oil, and will there be something that allows these tankers to flow through, or could we see an escalation? If you think back to Operation, Desert Storm, I was much younger back then, but all I remember is seeing, videos of oil fields just on fire, right? I mean, all of these, where they drill oil, just, flames shooting out. They just lit everything on fire all throughout Kuwait and all these other areas there. And what a, major disruption. So if we see some sort of an escalation that has a larger impact on oil, you're going to see sustained higher oil prices, and of course, a lot of inflation pressure, and of course, higher mortgage interest rates. Now, if the war continues, and we also see, that fear in the market, so the stock market's not doing well, there's just overall fear in the market, and we have inflation, that's when you get into kind of a stagflation situation. And, that would require this to go on for longer than anyone expects, with disruption in oil for longer than people expect, continuing to drive up those prices. So my opinion is that's probably not the likely scenario, but it's something that we should absolutely be keeping an eye on. What I've seen happen historically is that we see a spike in interest rates and a spike in oil prices, and we really need to give that full 72 hours to see what happens. And we're right around that time right now. So I'd be watching here as we round out this week, and by about the time you're watching this episode, what's going on with the transport of oil in the Middle East. Has that escalated, or has that, resolved itself? I will point out one interesting thing is, although 20% of the world's oil comes through the Strait of Hormuz, 50% of China's oil comes through that same strait. And so China has a very vested interest in making sure that those tankers are flowing. Now, how does that come into play in this situation? I don't know, but it is an interesting fact to consider. They're going to have a vested interest in freeing this up. So, like I said, just to kind of summarize this, what I expect is the, kind of best case scenario is this is a short-term spike in both oil prices and interest rates, and that we see this recover within a few days. There's a very good possibility that that happens, but it's not a guarantee. If we see, prolonged war efforts in the Middle East or further escalation driving up fear, that in theory is good for mortgage rates. I hate to say that, but it's true. But is it coupled with continued pressure about the oil? And it all comes back to the oil. Now, if you're in, mortgage and real estate, look, I think, the bummer about this situation and the timing of it is here we're in March, right? We're kind of already starting to see that return of the spring market. I've had talked to a lot of people that February was a real month of ramp up in production. And so, and that was on the heels of some of the lowest mortgage rates we'd seen in quite a while. The 10-year was under 4 for a minute. So we kind of had everything going in the right direction. We had the seasonality, those winds at our back. We had interest rates that had been falling. We had every indicator showing that inflation was pretty well in check. The labor market continued to be weak. All of that kind of pointing towards not a massive drop in interest rates in 2026, but a continued decline in interest rates. And now we have this going on. Now, I will tell you that if we see prolonged impact on oil prices, as I mentioned, this will be inflationary. And if we start seeing signs of inflation, this will almost certainly put a halt to any Fed rate cuts that we're expecting in 2026, right? I mean, they've made it pretty clear that if we see signs of inflation. Now, what's interesting is we didn't see this one coming, right? I mean, we thought inflation would come from continued tariffs, we thought maybe, the tariffs that were put in place just never quite made their way to the consumer, and eventually that would happen, or, other impacts. I don't think any of us thought that it could be, oil that, and this war in the Middle East that would lead to the inflation pressures that we potentially might see as this thing moves on. And that in and of itself, you guys, is a reminder that we don't know what sort of events can happen in the market that are going to move interest rates. There could be something that happens in the next period of time that drastically moves rates in the other direction, right? So we kind of make our predictions about what rates are going to do based on the overall trend that we see happening, and we can't plan for, black swan events, if you will, major shifts in geopolitical or otherwise, impacts to the economy, like we saw with COVID as an example, or when we saw, with 9/11. I mean, there's just big things that have happened that just take everything off the table. This is definitely a shift from what we were predicting, but it doesn't change the fact that everything we've said over the last 6 to 9 months is if inflation starts rearing its head again, the Fed will back off and interest rates could potentially stop their decline or even increase a little bit. And we just need to watch it and see what happens. We'll keep a close eye on it here for you. At Market Shares, of course, those of you in this industry will be watching it closely. But one last thing I want to touch on before I wrap up this episode is that what's interesting is that, and I just talked about this on my last episode where I talked about adjustable rate mortgages. Go back and watch that episode if you haven't watched it. It was phenomenal. But I got a lot of great feedback on that episode. But if you were to look at the coupons, we talked about this before, like which coupons are trading where, right? And we talked about how MBS Highway and other companies that track mortgage rates, they always got to choose the right coupon because there's always multiple coupons that are trading in the market, right? You get the 4.5, the 5, the 5.5, the 6. They all have some amount of activity going through them. The trick is to choose the one that has the most amount of volume trading through it and that's the most stable and predictable, which right now has been the 5.5 coupon, right? So 5.5 coupon is representing rates, maybe up as high as, 5 7/8%, 5 3/4%, somewhere in that neighborhood. Could be rates that are lower than that as well. Could be going into a 5.5 coupon. That's the one that most people are watching. And if you were watching the 5.5 on Monday, you saw, what was it, a 30 to 40 basis point increase. And so rates, got worse by 30 to 40. The MBS got worse by about 30 to 40. Or the prices, went down. But what's interesting is that the lower coupons have lost, like for instance, the 5% coupon, it's down 100 basis points. So if you were watching over the last 2 days, right? I'm recording this on Tuesday. So, we've seen a 30, 40 basis point loss in the 5.5, but close to 100, or maybe even a little bit over 100 on the 5 and the 4.5 coupon. So what that means is that the value of those lower coupons isn't quite what it was. So what you were seeing is people were quoting interest rates online as an example, and they were charging some discount points. I talked about this. They were charging enough discount points to get into those lower coupons because there was more value in those lower coupons. And the main reason for that is because the expectation is that rates are trending lower over time. Well, what we saw with this reaction is that the lower coupons took a much bigger hit than the higher coupons did. So what that tells me is we're going to see less opportunity to pay a little bit of points and get into that more kind of value-driven part of the rate sheet. I just thought that was interesting because we've talked about it here on the podcast. I wanted to point that out. Things like builder forward commitments and things like that, where you see, builders willing to pay a couple of points upfront to a lender to lock in a bulk of loans, and you see the rate and you're like 3.99 or like 4.5 or these crazy rates. They're nowhere close to where mortgage rates are at. You're like, how can they do that? That just doesn't make sense to me. And it's because they're buying note rates that slot into these more value price coupons, and looks like some of that deteriorated, right? So we saw some closure, if you will, some tightening between where the spreads are, where the price is on the lower coupons and that normal kind of 5.5 coupon, that typical mortgage rates today, that 5 3/4, low sixes, that range of rates are trading in. So anyway, it's just interesting to watch. Now, there's other times where we see the lower coupons, like I mentioned it on that podcast, when Trump announced the purchasing of mortgage-backed securities, it was those lower coupons that got a lot better. And the ones that we watched, the 5.5, which is where the market's kind of at, didn't have nearly the improvement that you would have expected. Well, that just kind of reversed with this move. And I wanted to make sure we pointed that out. So anyways, you guys, moral of the story is watch oil. Just watch what's going on with oil. We can't assume because there's unrest and there's war in the Middle East that, a lot of people's thought is, well, stock market's going to, take a hit. It's going to be a flight to safety. Mortgage rates are going to get better. Not necessarily, right? It really depends on the oil. Watch the oil and you'll have a good idea of what to expect with interest rates. I'm hopeful that we see what we've seen a few times in the past where there's concerns about it. It pans out to be not as big of a concern. Oil prices come back down quickly. Mortgage rates resume their, kind of track that they were on. And this is a blip on the radar. But we won't know until a little bit more time passes. So that's my update for today. I hope you enjoy this episode. If you do, and you want to make sure you keep a finger on the pulse of what's going on with interest rates throughout 2026, please subscribe to the channel, and you'll get a new episode from me every single Friday at 10 a.m. Pacific time. And until then, take care.